In my previous videos, we've spent a lot of time discussing the power of index funds. For 90% of people, that is the most efficient, low-stress path to wealth. You buy the whole market, you capture the average return, and you let time do the heavy lifting. It is the relaxed way to build a future. But some of you have reached out saying you want more. You want to move from being a passenger in the market to being the driver. You're looking at individual companies and you're ready to allocate capital more aggressively. If that's you, the rules change. When you buy an index fund, you are protected by diversification. When you buy an individual stock, you are exposed. To survive that exposure, you need a different kind of armor. In professional investing, this is called the margin of safety. This isn't a feeling or a vibe. It is a cold, calculated distance between the price you pay and the value you get. If you want to play in the active market without losing your shirt, this concept is non-negotiable. The biggest mistake rookie investors make is thinking that price and value are the same thing. They aren't. Every business has two separate identities. There is the market price, which is the number you see on your banking app. It changes based on headlines, political rumors, and collective panic. Then there is the intrinsic value, which is the cold, hard reality of what the business is worth, based on its cash, its debt, and its ability to generate profit. The margin of safety is the distance between those two numbers. Price is what you pay, value is what you get. The market is an emotional place. On any given Tuesday, a stock might be priced at $100 because people are excited. By Friday, a bad headline might drop that price to $70. Has the actual company, its factories, its patents, its cash flow, changed that much in 3 days? Usually no. Imagine you're looking at a house. You've done the math, looked at the neighborhood, and you know the house is worth $500,000. If you buy it for $495,000, you have almost no margin of safety. If the market dips 2%, you're underwater. But if you find a motivated seller and buy that same house for $350,000, you have a $150,000 cushion. That cushion is your margin. It allows you to be wrong. It allows the market to be volatile. It allows you to sleep at night while everyone else is panic selling. When you analyze a company, you're making guesses about the future. You're guessing what their sales will be in 2028. You're guessing what interest rates will do. You're guessing that their CEO won't make a catastrophic mistake. The margin of safety is the acknowledgement that your math might be wrong. Let's look at a formula. If you calculate a company's intrinsic value and find it to be $100 per share, a disciplined investor doesn't buy at $95. They might set a buy order at $70. That 30% is your error room. If the company grows slightly slower than you expected, or if a competitor enters the market, you're still protected because you bought the asset at a deep discount. Active investing isn't about being right all the time. It's about making sure that when you're wrong, it doesn't break you. The hardest part of this isn't the math, it's the waiting. Active investing isn't about constant movement. It's about having the discipline to stand still while the crowd rushes toward the latest trend. We often see people pouring money into popular sectors where prices are driven by excitement and social pressure rather than the actual health of the business. You might believe in the company's future, but if the price is too close to its true value, you have no room for error. The risk is simply too high. When the market eventually cools down, those who bought at peak prices often face heavy losses. However, the investor who kept their cash ready does more than just survive the drop. They take advantage of it. By waiting for the price to fall significantly below what the company is actually worth, you are buying a safety net. This isn't a matter of luck. It's about the mental strength to wait for a clear opportunity while everyone else is chasing high prices. To turn this into a documented, repeatable process, I use a specific checklist. This is how I filter the noise and find the gold hidden in the market. Free cash flow. Is the company actually generating cash, or is it just accounting profit? The moat. Does the company have a competitive advantage that prevents others from stealing its customers? Debt to equity. Is the company over-leveraged? A company with no debt cannot go bankrupt. When you find a company with high cash flow, a strong moat, and low debt, you've found a quality business. But even a quality business is a bad investment if you pay too much for it. The margin of safety is your final filter. It's the no button. Most of the time, your research will lead you to a no. And that's okay. In the active market, success comes from rejecting the average and waiting for the rare intersection of a strong company and a low price. Now, we need to clear up some misinformation. Wall Street wants you to believe that volatility is risk. They want you to think that because a stock price is jumping up and down, it's risky. This is false. Risk is the permanent loss of capital. Volatility is just the market being moody. In fact, for a disciplined investor, volatility is your best friend. Volatility is what creates the margin of safety. If a stock never moved, the price would always reflect the value, and you'd never get a deal. You want the market to be erratic. You want people to panic over short-term news because that is what drives the price down into your safety zone. This approach requires a complete detachment from the crowd. It requires you to be comfortable being wrong in the short term so you can be right in the long term. If you're still in the phase of building your foundation, stick with the index funds. There is no shame in the relaxed path. It works. But if you are ready to take control, if you are ready to build a portfolio of businesses you actually understand, then the margin of safety must be your religion. You don't need to be a genius to do this. You just need to be more disciplined than the person sitting next to you. Building wealth is a serious business. The margin of safety isn't just a financial tool, it's a life strategy. To help you get started without spending hundreds of hours on research, I've created a simple valuation worksheet. You can download it for free via the link in description. If you are ready to stop being intimidated by the green and red numbers and start understanding the actual machinery of wealth, I want you to join me on this journey. I'm documenting everything I learn as I continue to navigate the world of finance, and I'm breaking it down so we can all rise together. Let's get to work.